Welcome to the Deep Dive, your shortcut to being well-informed on the stories shaping the market. Today, we're taking a deep dive into Vontier Corporation's second quarter 2025 earnings call.
Yep, Vontier.
Our mission, well, like always, is to pull out the most important nuggets of knowledge, the key insights, helping you understand what really drove these results.
Right.
And what management is signaling for the future. Because Vontier, well, they delivered a quarter that clearly got the market's attention. Pretty robust performance.
Oh, definitely.
Yeah.
This Vontier call gives a fascinating look into, a company navigating some pretty dynamic market conditions.
Yeah.
And they seem to have a very clear strategic playbook. We're going to explore those strategic pillars they're leaning on,
Okay.
the impact of new products, and crucially, how they're positioning themselves for, sustained growth, especially in connected mobility.
That's the key phrase, isn't it? Connected mobility.
Yeah, it really is.
Right.
And what's striking here is how the market reacted, both to the numbers, the raw numbers, and the commentary looking forward. It kind of suggests investors are buying into the story.
Okay, so let's go right to those numbers then, the ones everyone's buzzing about.
Let's do it.
Vontier reported non-GAAP, that's adjusted, earnings per share of $0.79, which, well, it impressively beat the consensus by 7 cents. That's nearly a 10% beat.
Almost 10%. That's significant.
Yeah. And it wasn't just the bottom line. Revenue also surged past expectations, came in at $773.5 million against a consensus of what? $734.2 million?
Right.
That's an 11.1% increase year over year. And core sales grew a very healthy 10.8%.
And you're right. It wasn't just about hauling in revenue. Profitability saw a really nice boost, too.
Okay.
The adjusted operating margin, it expanded by 80 basis points compared to last year, reached 21.1%.
So better margins.
Exactly.
Okay.
A strong sign of, effective cost management, good operational discipline. And then there's cash flow.
Always important.
Always. Adjusted free cash flow was strong at $89 million. Solid 76% conversion rate. These are the kinds of numbers, balanced growth, margin expansion, strong cash that really resonate with investors. Gives them a strong foundation.
Yeah, those aggregate numbers, they definitely paint a compelling picture. But to really get Vontier's trajectory, we need to kind of dissect it, right?
We can lock it down.
Which parts are accelerating, which might still be, facing some headwinds. Let's peel back the layers. How did this play out segment by segment? Maybe start with environmental and fueling solutions. Sounded like surprising strength there.
Absolutely. EFS, Environmental and Fueling Solutions, was a definite standout this quarter.
Okay.
Sales grew an impressive 16.2% year over year. That's $361.6 million.
Yeah.
And critically, margins also expanded 50 basis points up to 29.2%.
Wow.
We saw dispenser shipments jump over 20%. Their environmental solutions grew high teens.
So broad strength.
Pretty broad, yeah. But the really compelling part, the thing with the long-term tailwind, Vontier got selected by one of North America's biggest convenience store operators. Huge deal.
Okay, what's the deal?
They're going to upgrade the automatic tank gauges, the ATGs. Yeah. These are the systems monitoring fuel levels, preventing leaks.
Right. Essential stuff.
Essential. Across 4,500 sites. Over the next 5 years.
4,500 sites.
Yeah. And what's more, this operator is also adopting Vontier's new cloud-based device management software.
Ah, the software angle.
Exactly. This isn't just one big contract win. It signals, we think, the early stages of a pretty significant U.S. tank replacement cycle.
So a whole wave of upgrades.
Potentially. It's like a shift in convenience store infrastructure. Moving from old hardware to integrated cloud-managed systems, it effectively turns Vontier into more of an ecosystem provider, not just selling products.
Which means stickier customers, right? Higher switching costs.
Precisely. Strengthens their long-term competitive moat.
Yeah.
That's a really key insight from the call, I think.
That North America deal does sound incredibly significant, strategically huge. And mobility technologies also showed remarkable strength, didn't it? That seems to be where a lot of the excitement is.
It absolutely did. Mobility technology sales jumped 17.9% to $280.2 million.
Nice jump.
And margins expanded even more impressively, 180 basis points to 19.1%.
Okay, what drove that?
Primarily fueled by Invenco.
Yeah.
Their payments business grew over 20% for the fourth consecutive quarter.
Fourth quarter, wow.
Yeah, consistent growth. And the adoption of their SelectPay 6 payment terminal is really accelerating. Over half of new dispensers now leave the factory with that unit built in.
So it's becoming standard.
Getting there. And Invenco's recurring revenue, which is about 35% of its base.
The software part again?
Exactly. That was up a strong 17% year over year. And get this, transaction volume on Invenco payment servers actually passed 1 billion.
1 billion transactions.
Staggering amount of activity, right?
Yeah.
Shows the scale they're reaching.
That's a huge milestone for Invenco. Okay, but within mobility tech, what about DRB? The car wash automation, I remember that faced some pressure. Was there an acquisition?
You're right to bring up DRB. Sales were down in the teens this quarter, which was anticipated.
Okay.
But it's expected to inflect positively later this year. And a big part of that is the Sargent Suds acquisition.
Sargent Suds. Sounds like a character.
Huh? Yeah. It's actually smart tunnel control software for car washes.
Ah.
So this tuck-in acquisition, it deepens DRB's automation stack, adds critical smart controls, integrating hardware and software. It only added about $7 million in revenue, $1 million in EBITDA last year.
Small numbers.
Small numbers now, but the strategic value in enhancing DRB's offering long-term is much bigger. It's about selling more complete integrated solutions, moving up the value chain in that niche.
Got it. So strong momentum, strategic wins in EFS and mobility tech.
Definitely.
But it sounded like repair solutions. That segment faced more persistent headwinds, kind of balancing out the growth elsewhere.
That's a fair way to put it. Repair solutions sales were largely flat, $150.8 million. Margins actually contracted slightly, 50 basis points down to 20.8%.
No, why the flatness?
Still grappling with those macro headwinds,
Yeah.
impacting higher ticket technician spending.
So deferring big tool purchases.
Exactly. Though demand for lower price point productivity tools, that remains solid.
So mixed picture within the segment.
Yeah. And Vontier is actively de-risking here too, reducing exposure to China, targeting less than 10% by year-end, down from 20%, plus implementing pricing actions.
Okay.
But despite some stabilization, management basically said it's too early to call a clear inflection upward for repair solutions.
Right. So that's something for you, the listener, to keep an eye on. It does impact the overall story.
Absolutely.
Okay, given these mixed results, strong EFS and mobility, flatter repair solutions, what's the outlook for the rest of the year? Did they raise guidance?
It certainly did, reflecting that strong first half and, well, increased confidence.
Okay.
Vontier raised its full year 2025 adjusted EPS guidance, now $3.10 to $3.20, up from $3 to $3.15 before.
These a bump.
Yeah. And full year sales, now projected at $3.02 to $3.07 billion. They also notably raised their adjusted free cash flow conversion target, now aiming for approximately 100%.
100% FCF conversion. That's impressive. What's behind that big jump?
Well, partly the strong operational execution we talked about, but also the recent passage of a significant piece of U.S. legislation. Yeah, a bill that management referred to on the call as, well, they called it the Big Beautiful Bill.
The Big Beautiful Bill. Okay.
Yeah, it allows R&D expenses to be immediately expensed rather than capitalized over time.
Ah, an accounting change with real impact.
Exactly. Direct positive impact on reported earnings and free cash flow. It's a nice tailwind.
That's fascinating. Unusual name aside, but when do they expect the full benefits of that change, especially for their customers? Does it make customers spend more right away?
Good question. So Vontier benefits immediately on their own R&D expensing.
Right.
But translating that into customer capital spending decisions, especially for smaller operators, maybe in the DRB segment, that takes time. Management anticipates those benefits reading through more clearly next year. So while the tailwind is real, it's not an immediate flip of the switch for customer spending, something for you to factor in.
Got it. And Q3 guidance specifically?
For Q3, adjusted EPS guided to $0.74 times, or $0.74 signs, $0.78. They do expect core sales to be roughly flat in Q3.
Flat? Why is that?
Mainly due to some favorable shipment timing in Q2. They pulled forward about $15–20 million in sales. So Q2 got a bit of a boost from Q3's business.
Okay, timing shift. Makes sense. All right, we've dissected the numbers, the guidance. Let's connect the dots. What does this all mean for you, the investor? How do these strategic initiatives, connected mobility, software platforms, how does it all tie together in the bigger picture?
What's genuinely compelling, I think, is seeing how Vontier's strategic shift is really gaining traction. It's transforming the company.
Oh, so?
They're actively expanding that recurring revenue base. It's now about 40% of Mobility Technologies revenue.
40% recurring.
Right. Yeah, through things like Invenco's NFX platform, Drive's EV charging software, DRB's Pantheon software. This isn't just adding revenue streams. It's a fundamental shift.
towards more predictable, higher margin software and services.
Exactly. That helps mitigate the ups and downs of hardware sales, differentiates them. Innovations like Teletrac Navman's AI camera for fleets.
Multi-IQ.
Right. That's a great example of embedding intelligence, software, into their hardware. The whole strategic story is clear. They're moving from portfolio repositioning to actively scaling these software-enabled mobility platforms.
And that focus on recurring revenue, software, that's a critical lever, isn't it? Changes the risk profile, maybe even the valuation over time.
It absolutely does. It's a shift, potentially, from being seen as just an industrial company to something with a much stronger tech component,
Right.
which often commands a premium, right?
Definitely. And how are they managing capital allocation during this transformation? Buybacks, debt.
They kept a balanced approach in Q2. Did about $50 million in share buybacks. That brings the year-to-date total to $105 million. And at the same time, they reduced net leverage down to 2.5x.
So returning cash, but also keeping the balance sheet healthy.
Exactly. That balanced approach is important. Rewards shareholders, but keeps flexibility for future bolt-on acquisitions, like Sargent Suds, which proved pretty effective strategically.
Right. So how has all this translated into market performance? Are investors noticing this shift compared to, say, other industrials?
The market certainly seems to be taking notice. Vontier has clearly outperformed the industrials ETF, XLI.
Across what timeframes?
Across 1 month, 3 month, and 1 year periods. That suggests investors are increasingly recognizing the value here, the strategic transformation, the operational execution.
Okay, so looking ahead, what are the key catalysts for you to watch?
Definitely the Q3 earnings sprint. Continued progress on that U.S. tank replacement cycle. It's a multi-year thing.
Right.
DRB order trends, especially after integrating Sargent Suds. And more wins in EV charging software. Plus, they have an investor event planned for mid-October.
Investor Day. Usually get more detail there.
Usually, yeah. Likely more on the long-term vision. Which raises the big question for you, the listener. Can Vontier keep up this outperformance as they scale the software side? Will they earn that higher tech-like multiple?
Good question. All right, shifting gears, let's move to our not financial advice segment.
Okay, the fun part.
Yeah, for the seasoned investors listening, here's where we brainstorm a bit. Almost a thought experiment. If you had to pitch a wild but plausible trade idea to an investment committee inspired purely by this Vontier call, what would it be?
Okay. Given Vontier's really compelling pivot to connected mobility and software, but also acknowledging the drag from repair solutions.
Right, the counterweight.
Yeah. A highly targeted pairs trade comes to mind.
Okay, pairs trade. Long Vontier, short something else.
Exactly. Long VNT, but specifically hedge out the exposure to repair solutions.
How would you do that? Short the whole tool sector?
No, not the whole sector. That's too broad. You'd need to identify a, say, small cap publicly traded company whose business is almost purely traditional higher ticket technician tools.
Find a pure play tool company.
Right. Maybe one that's demonstrably struggling with those same headwinds Vontier mentioned, consumer discretionary spending, maybe import tariffs, whatever's hitting that specific niche hard.
Okay, find that company.
And then you short that company in an amount carefully calibrated to offset the approximate revenue and margin profile of Vontier's repair solutions segment.
So you're trying to neutralize the tool part of Vontier.
Precisely. It effectively lets you isolate and hopefully benefit from Vontier's booming EFS and mobility tech segments.
Yeah.
While neutralizing the cyclical drag from their tool business.
Creating a synthetic, software-focused mobility tech pure play out of a diversified industrial.
You got it. It's a pure play bet on Vontier's digital transformation. Wild, but plausible, right?
Plausible definitely requires some finesse, though. Okay, let's recap our deep dive. Vontier delivered a strong Q2, impressively beat expectations top and bottom line, raised full-year guidance.
Check, and check.
This performance, largely driven by that robust growth in environmental and fueling solutions mobility technologies, bolstered by smart acquisitions, clear focus on connected mobility, recurring revenue, and the market reacted positively. Seems like growing confidence in the strategy, the transformation.
Indeed. Vontier's showing compelling execution, especially given the complex macro backdrop, the shift to software platforms, the boost from that legislative change. It gives them a pretty solid runway. But the performance of repair solutions, that remains key to monitor, as does the pace of adoption for their newer solutions, like in EV charging and car wash automation.
Yeah, those are critical indicators for the long term.
Absolutely.
So as Vontier continues this journey, shifting from diversified industrial towards more software, more connected mobility, the big question really remains, doesn't it?
Which is?
Will the market ultimately re-rate Vontier? Will its valuation multiple start looking more like a high-growth tech company than a traditional industrial? Something for you to ponder.
Definitely something to watch.
And remember, this deep dive is for informational purposes only. It should absolutely not be considered financial advice.
Please don't. Always do your own homework.
Do your own due diligence before making any investment decisions. We appreciate you joining us on the deep dive. Let us know your thoughts, what you'd like us to cover next.
Yeah, thanks for listening.
Have a great day.